Everyone thinks empires fall because of invasions, assassinations, or bad emperors. We love dramatic endings. Flames over Rome, a king losing colonies, a red flag lowering over the Kremlin. But if you look closely, beneath every grand collapse is a quiet number ticking upward like a countdown, a simple ratio that no empire has crossed and survived. And the paradox is that no one notices it rising until it's already too late. We're told Rome fell in 476 because of barbarians. But Rome's borders had been breached before. They survived worse. What they couldn't survive was reaching a point where the state owed as much as it produced. When the empire's debt and obligations hit the size of its entire economy, 100%, the barbarians were just the final nudge. The math had already done the damage. Britain's global empire supposedly unraveled after World War II because of geopolitical exhaustion. But look at the Bank of England's books in 1946. Look at the sterling balances owed to India, Egypt, Australia, Canada, promises Britain made to finance a war it couldn't afford. The moment Britain's liabilities crossed its national income, the empire wasn't conquered, it defaulted in slow motion. The sun didn't set on British power, it was repossessed. The USSR is described as a political failure, a system that simply couldn't innovate. But in 1989, the Soviet state hit its own 100% ratio. Hidden military debts, unpaid obligations to satellite states, collapsing export revenues. The planned economy wasn't defeated by capitalism. It was suffocated by arithmetic. And here's the part that should make you pause. The United States, the modern empire of reserve currencies, global bases, and financial dominance, is projected to cross that same line in 2026. 100% of national income consumed by federal interest, obligations, and debt service. The same fatal threshold Romans crossed when they debased the denarius. The same point Britain hit as it mortgaged its empire. The same line the USSR crossed when oil revenues dried up. Different eras, different ideologies, same mathematical cliff. If you've ever wondered why great powers look unbeatable one decade and brittle the next, this is the hidden mechanism. Empires don't fall when their enemies grow stronger. They fall when their numbers stop obeying their politics. Everyone remembers the drama of collapsing empires, but almost no one asks the quiet question: who built the financial mechanism that doomed them long before the final crisis? Because none of these failures were sudden, they were engineered, sometimes intentionally, sometimes accidentally, by systems designed to solve yesterday's problems with tools that guaranteed tomorrow's catastrophe. To understand the 100% ratio, you have to step backward to the moment each empire decided it could outsmart limits. Rome's moment came in the 3rd century, when Emperor Septimius Severus told his troops, "Enrich the soldiers and scorn all others." Sounds bold, almost heroic. What he really meant was, fund the army at any cost. And since raising taxes was dangerous, he turned to the easiest financing mechanism available, the imperial mint. The denarius, once 90% silver under Augustus, fell to barely 5% by the time of Gallienus. The state invented a system where obligations, military pay, grain doles, pensions, could be expanded infinitely, while real output could not. This was Rome's early version of the mechanism that would later be formalized as public debt: promises today, extraction tomorrow. Britain built its version far more elegantly. In 1694, a consortium of London merchants created the Bank of England, a private company with a public mission and a monopoly on issuing notes backed by government debt. In simple terms, the state borrowed money, and in exchange, the bankers received control over the currency. This wasn't a conspiracy, it was genius. It allowed Britain to finance wars against France, Spain, the Dutch, wars it could never have paid for with mere taxation. The mechanism produced victory after victory, global trade routes, and the largest empire in history. But behind the triumphs hid a dangerous foundation. Every expansion of power required expanding the state's obligations. By the 1800s, the British government wasn't just borrowing. It was rolling over old debts with new ones, paying interest with more interest, a perpetual motion machine powered by future taxpayers. The USSR had no central bank in the Western sense, but it built an even more rigid version of the same system. Gosplan and the Ministry of Finance operated like a single entity, assigning output targets, military expenditures, and internal loans that never circulated publicly but accumulated internally. From the 1960s onward, the Soviet Union quietly relied on foreign credits, from Western banks, from Comecon partners, from petrodollars. Behind the controlled prices and planned production sat an invisible spreadsheet of obligations that had to be met with real outputs: oil, grain, machinery. When those outputs slowed, the obligations did not. You can see the pattern forming. Each empire invented its own financial technology to push its power further. Rome used debasement. Britain used bonded debt. The USSR used planned credit flows. Different tools, identical purpose. Expand capacity now by mortgaging tomorrow. And for a while, it worked brilliantly. Historians praise the cultural achievements, the military victories, the technological progress, but all of it was financed. The Colosseum was funded by spoils extracted from provinces who were falling behind economically. The British Navy that ruled the seas was paid for by paper promises piling up in London counting houses. Soviet industrialization in the 1930s was fueled not only by ideology, but by forced requisitions, internal IOUs, and later external loans. What these systems created was not merely debt, it was dependency. The state became addicted to a mechanism that allowed it to postpone real costs indefinitely. Once the tool exists, it is never retired. Rome kept debasing, Britain kept borrowing. The USSR kept expanding its internal obligations, and each time the system grew, the threshold moved closer, the moment when the obligations hit 100% of national output. Imagine a scale where one side holds everything an empire earns in a year, and the other side holds everything it owes. As long as the earnings outweigh the obligations, the system continues. But once the obligations reach parity, once the state owes as much as it produces, the laws of arithmetic override the laws of empire. The consequences look political, social, ideological, but the root is numeric. This mechanism wasn't created by villains, it was created by problem solvers, emperors who needed armies, ministers who needed fleets, planners who needed factories. They all believed they were building stability. But systems don't collapse because of bad intentions. They collapse when numbers outgrow gold, real income, or trust. Everyone loves the rise of an empire. It feels clean, confident, and inevitable. But what we rarely admit is that every rise contains a hidden illusion, the belief that the mechanism powering the growth can never turn against its creator. Rome believed its debasement was simply adjusting the currency. Britain believed its national debt was a sophisticated financial instrument, safely managed by the city. The USSR believed its planned credit system was scientifically insulated from crisis. And for decades, each empire looked correct. The illusion worked beautifully. Look at Rome first. When the silver content of the denarius fell, people didn't panic. They spent it faster. Trade expanded, soldiers were paid on time, veterans received their pensions, baths were built, arenas expanded, roads stretched outward across Europe, Africa, and the Middle East. As long as money moved, the illusion held. More coins meant more prosperity. But underneath, prices rose, taxes needed to be collected in kind, and eventually even tax collectors refused to accept the emperor's own currency. Yet during the boom, no one cared. You don't question the roof when the sun is shining. Britain's version was even more seductive. After the creation of the Bank of England, debt-financed expansion appeared limitless. During the Napoleonic Wars, the British government borrowed sums equivalent to 200% of its annual income. And instead of sinking, the empire exploded across continents. Railways, colonies, telegraph cables, global trade insurance, all of it was built on paper promises circulating through London's discount houses. The illusion was so strong that by the mid-1800s, British citizens believed national debt was a sign of sophistication. Other countries envied it. Governments from Mexico to Greece begged British banks to lend them money just to imitate the empire's growth model. It was debt monetized into prestige. The USSR's illusion had a scientific glow. Central planners filled charts with rising lines. Steel output up, wheat yields up, military capacity up. Every 5-year plan promised more. Even when shortages appeared, the numbers looked impressive. Internal credit between ministries created the image of solvency, and foreign loans from Western banks in the 1970s boosted the illusion of modernity. Soviet citizens were told the system was storming toward communism, and planners genuinely believed the math would always work because they controlled every variable. If you dictate prices, wages, interest, and quotas, how can the system fail? That was the illusion. What binds these empires together is the moment when bright growth blinds the architects. You and I know this feeling on a smaller scale. When your income rises, you're tempted to take on commitments because everything seems stable. You promise future you will handle the costs. Empires think the same way. The Romans expanded obligations to the army because the provinces were still paying. Britain expanded colonial administration because trade revenues were still climbing. The USSR expanded subsidies to its satellite states because oil prices were still high. When the machine is roaring, nobody checks the bolts. The key illusion is always the same: the belief that positive trends are permanent. Rome believed silver output would continue. Britain believed global demand for sterling would never fall. The USSR believed oil and gas exports would cover internal inefficiencies forever. And because these illusions held for decades, even generations, people mistook momentum for immortality. This is why the 100% ratio is so dangerous. It doesn't appear at the beginning. It appears after long success. When an empire has grown so confident in its financial mechanism that it doubles and triples down. Rome's emperors issued more debased coins because the system had worked for a century. Britain kept borrowing because every war financed this way had ended in victory. The USSR tightened central planning because it had industrialized faster than expected. Success reinforced the mechanism that would later destroy them. During the boom, critics always sound like paranoids. Roman senators who warned about currency collapse were dismissed as old men stuck in the past. British MPs who questioned endless borrowing were mocked as provincial. Soviet economists who whispered about unsustainable obligations risked prison. When illusions are profitable, truth becomes unwelcome. The irony is that every empire at its peak believes it has surpassed arithmetic. The rules that bind ordinary nations supposedly don't apply. Their currency is special, their markets are deep, their ideology is superior. And for a moment, sometimes for a century, it feels true. But numbers do not bend forever. They stretch slowly, invisibly, until one day the obligations equal the output. The scale evens. Not a crisis yet, but the point of no return. If this phase of illusion feels familiar when you look at our own era, right where in the world you're watching from, everyone imagines collapse as a sudden earthquake, a barbarian crossing a river, a naval defeat, a breadline stretching across a cold capital. But real collapses don't start with the dramatic moment. They start with the quiet click of a number crossing a boundary. The moment obligations hit the size of national output, 100%. Politics becomes irrelevant. Ideology becomes irrelevant. Even military power becomes irrelevant. At that point, the empire is no longer choosing its future. Arithmetic is choosing for it. Rome reached this boundary almost invisibly. By the 260s, the empire's annual obligations, military pay, grain distributions, frontier maintenance, matched what the empire could physically extract in taxes and tribute. The silver denarius had become bronze dust with a silver wash. So when the Goths crossed the Danube in 269, Rome wasn't defeated by the Goths. It was defeated by its own ratio. Soldiers demanded real payment. The treasury offered hollow coins. Provinces refused tax collectors. Inflation soared not because people were greedy, but because the imperial machine had hit the 100% wall. When obligations equal output, every additional promise dilutes everything that came before. That's when trust evaporates, and no emperor, no matter how skilled, could command trust that the currency itself destroyed. Britain's exposure came with less blood, but more humiliation. After World War II, London found itself with sterling liabilities to the tune of tens of billions of pounds, promises to India, Australia, Egypt, and dozens of other countries that had supplied wartime goods in exchange for IOUs. In 1946, Britain attempted to resume the pre-war financial order, but it had crossed the ratio. The empire owed as much as the nation could produce in a year. When a country reaches that point, it stops being the lender and becomes the collateral. The United States saw this clearly and pushed the 1946 Anglo-American loan with one brutal condition. Sterling would become convertible to dollars. Convertibility lasted 6 weeks. Once colonies attempted to cash in their sterling balances, the illusion shattered. Britain suspended convertibility and quietly accepted a new reality. This was not a geopolitical shift. It was a mathematical one. You cannot run a global empire when your promises weigh as much as your entire economy. The pound didn't lose global status because America became strong. The pound fell because Britain crossed the 100% line years earlier and tried to pretend it hadn't. The USSR's exposure was equally predictable once you see the underlying ratio. By 1989, the Soviet states' internal obligations, guaranteed wages, subsidies to satellite nations, military expenditures, debt to Western banks, matched its entire annual national income. Oil prices, the lifeblood of late Soviet solvency, collapsed from $35 a barrel in 1980 to under $15 by 1986. That drop wasn't just an economic shock. It was a fatal mathematical change. Output shrank, obligations remained fixed, and suddenly the ratio hit the boundary. When Gorbachev tried to reform, he wasn't opening the system. He was exposing the equation. Perestroika didn't cause the collapse. It revealed it. That's the secret no history book tells you. Each of these collapses started after the 100% ratio was crossed. Military defeats, decolonization, political reforms, they were symptoms, not causes. The real cause was the moment when promises made by the empire could no longer be supported by the real economy beneath it. This is the point where leadership no longer matters. Rome tried strong emperors and weak ones. Britain tried austerity and Keynesian spending. The USSR tried tightening controls and loosening them. None of it mattered because the math was already irreversible. Once obligations equal output, every solution creates a new problem. Cut spending, you lose political stability. Raise taxes, you destroy economic activity. Borrow more, the interest accelerates the collapse. Print money, trust evaporates faster. Empires don't die because they are attacked. They die because they become unfinanceable. The final triggers, invasions, rebellions, political breakdowns, are simply the surface cracks. The foundation had given way years earlier. When an empire crosses the 100% ratio, collapse unfolds in stages. First, the economic foundation cracks, then the political facade splinters, and finally, the global architecture shifts. Rome fractured into regions ruled by generals turned warlords. Britain shrank from a world-spanning system to an island managing austerity. The USSR dissolved into 15 new states almost overnight. But the most important part isn't what happened then. It's what the same mechanism is doing now. Because today, the global financial system has a single core, the United States. And the same math that snapped Rome's denarius, Britain's sterling, and the USSR's planned economy is quietly approaching its boundary again. Not in theory, not in forecasts, in published official numbers. In 2024, the U.S. federal government spent more than it earned by a margin that would have shocked every previous generation of Americans. Interest payments alone surpassed the defense budget. And by the start of 2026, the Congressional Budget Office projects something unprecedented in the history of any reserve currency empire: federal interest and mandatory obligations reaching 100% of national income. The exact threshold that marked the point of no return for every empire we discussed. But the modern echo is bigger because the US sits at the center of a global web of dollar-denominated debt. When Rome fell, its collapse mostly affected the Mediterranean. When Britain's pound lost status, global trade reorganized. When the USSR imploded, its shockwaves were regional. But if the United States crosses the 100% threshold, it's not one empire destabilizing. It's the anchor of the world monetary system. And here's the quiet truth almost no one says out loud. America already mirrors the stages of late empires. The Roman illusion was that debasement was temporary. Today, the Federal Reserve insists quantitative easing isn't real money creation. It's balance sheet expansion. Britain believed its debt was safe because global trade depended on sterling. Today, the US believes its bonds are safe because there is no alternative. The USSR believed it could centrally manage its obligations. Today, Washington announces inflation targets, interest pathways, and growth expectations as if confidence alone can command outcomes. But beneath these narratives, the same structural consequences unfold. Inflation becomes sticky because obligations must be financed through money creation. Productivity growth slows because capital flows to servicing old promises instead of building new assets. Political conflict intensifies because the pie stops expanding and every group fights for the same shrinking share. Trust erodes as citizens realize the currency they earn buys less each year. This is not prophecy, it's pattern recognition. In 1789, French assignats were declared secure because they were backed by land. In 1946, sterling was declared solid because Britain had historic credibility. In 1988, the ruble was declared stable because the USSR was too large to fail. Every empire believes its currency is exceptional, right until the instant it isn't. The consequences of crossing the ratio aren't symbolic, they are mechanical. When an empire owes as much as it produces, it must borrow just to stand still. That borrowing raises interest costs, which accelerates the ratio further, forcing more borrowing, a spiral. Eventually, both domestic and foreign investors demand compensation for the risk. Yields rise, the currency weakens. Policymakers try to restore stability, but every tool comes with a cost. Raise rates, and debt service explodes. Cut spending, and political upheaval follows. Print money, and inflation accelerates. No combination solves the arithmetic. This is why observers around the world, from Beijing to Riyadh to Brasilia, are quietly preparing alternatives to dollar dependence. Not because they expect the US to disappear, but because they recognize the unmistakable early symptoms of a system approaching its boundary. The symptoms every previous empire displayed. When you overlay the charts, Roman debasement percentages, British debt to income, Soviet obligations to output, and modern US federal obligations, the lines look eerily similar in their late stages. Slow rise, plateau, sudden vertical climb. And always, the vertical climb ends the same way. The modern echo is not just America approaching the threshold. It's the world watching, sensing, calculating what comes after the reserve currency crosses a line no empire has ever crossed and remained dominant. Everyone thinks history moves because of great leaders, brilliant generals, and dramatic decisions. But when you study empires not as stories, but as systems, you discover something unsettling. The true engine of collapse isn't ideology. It isn't morality. It isn't even war. It is the silent moment when the promises of a society grow faster than the real world that must fulfill them. The Romans believed virtue would save them. The British believed institutions would save them. The Soviets believed ideology would save them. Each was wrong for the same reason. Numbers do not bend to belief. When obligations equal output, when an empire is consuming tomorrow to survive today, the system has already chosen its ending. The rest is choreography. If you're hearing this in 2025 or 2026, you're living inside one of those transitions. Not a collapse. Those take years to reveal themselves fully, but a boundary crossing. A point where the financial rails of the last 80 years begin to shift under the weight of their own commitments. You will hear politicians argue. You will hear economists reassure. You will hear central banks promise control. But what you're really hearing is the same chorus every empire sings on the eve of its recalculation. Here's the uncomfortable truth. Systems don't collapse because people are foolish or corrupt. They collapse because the arithmetic becomes heavier than the trust holding it together. When a nation must borrow to pay interest, when its currency must inflate to preserve stability, when its obligations consume its output, the clock doesn't strike midnight. It simply continues ticking in one direction. The lesson isn't despair, it is responsibility. Empires fall, but people adapt. Currencies weaken, but work continues. Systems reset, but life reorganizes. The warning is simply this: do not mistake momentum for safety. Do not assume that because something has worked for decades, it must work forever. And do not ignore the quiet math that has toppled every great power before us.